and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, recently, a lot of international funds have stopped taking fresh investments, citing regulatory reasons. So, what are these regulations and what should you do now? You will get to know all of this in this episode.
For the first time, mutual funds, ever since they were allowed to invest abroad, they have hit the limit prescribed by Reserve Bank as well as SEBI. Reserve Bank's limit prescribed for mutual fund is $7 billion on an aggregate for the whole industry. So all mutual funds put together, they can invest $7 billion. SEBI has prescribed the limit for individual funds at individual asset management company level at $1 billion. So some companies are hitting the limit of $1 billion, but the $7 billion, the whole industry is close to that or maybe has breached that. So the industry can't invest abroad. They will be violating the RBI mandates. If they keep taking money and they don't invest abroad, they invest locally, it will be violation of the prospectus, their stated objective that they are supposed to invest abroad. If they keep it cash, that will again be violation of their stated mandate. So they have no choice but to stop accepting money. Simply because they have a separate window, as there is a $7 billion limit for international fund. There is an independent specific thing for ETF. In international ETFs, there is another additional limit of $1 billion. So the ETF limit has not been breached. I don't think the industry has come closer to that. So that is why they are accepting money. So if you have to invest in international ETFs, now there are different forms. There are international ETFs, but those ETFs are actually, the funds are not investing in those ETFs. It might look like an ETF to you here, but the fund company is investing in the respective stocks directly. So even if it's some of the ETFs, they are taking money because they are investing in ETFs. That is what the rule says. But if a fund company is running the ETF by investing the underlying constituents in the same proportion, then they can't take money because they come under that $7 billion that limit. So this is the reason why some of the ETFs are still taking money. It is due. It is expected, and given the foreign exchange reserve position of our country, it should be possible. But at the same time, the global turmoil that we are witnessing right now, it has not helped it. And I think the greater uncertainty right now, that has actually added to the whole delay. And the kind of time it has taken so far ever since this industry, the overall limit has been hit. I'm wondering that whether it is just a procedural delay or it is a deliberate delay. If it is a deliberate delay, I think the bets are off. I think it might take any time, and that is bad luck. But hopefully it should happen, because ever since if they are allowed by the central bank, it will take very few days to implement it. Investors have no choice, but you really just can't be investing abroad simply because there are some ETFs where you can invest. They are the second best vehicle. That is a choice, but that is also there is also a possibility that once you start putting your money in the ETF, they will also quickly hit the limit. Then investors are left with a choice of waiting for the central bank to increase the limit or invest in some other way. And there are new ways of investing abroad is opening up. For example, one is that every investor can invest abroad directly as well. You can buy a stock. Of course, it is not as simple as investing in a mutual fund. The great advantage that you get from a mutual fund is that all kind of regulatory risk or any kind of transaction risk, that gets substantially, I would say not substantially reduced, but gets completely eliminated. Because you are not bothered about, look at when you invest in a mutual fund, which is investing abroad, you write a check of 100,000 rupees, 1 lakh rupees, and next day you are allotted exactly the same way based on that day's NAV. So it's very simple. When you want to redeem it, the same transaction cycle gets reversed. You want to redeem, depending on the NAV, the money is realized and the money hits your bank account. If you want to invest abroad in stocks, you have to worry about a couple of things. One, open a brokerage account with a foreign broker. There are many foreign brokers which are enabling or facilitating opening of such accounts in it for Indian investors. Then you have to fund that account, which means that you have to move your money from your bank account, convert it into dollar, then you buy it and you follow the settlement cycle. Then there are other nuances. If you buy a stock and if you buy a share, if you buy a stock in the US, the company gives a dividend and the US government holds back the equivalent of a TDS, the tax deduction at source. Assuming that you bought Apple share and Apple, the company, gave a dividend, then a certain percentage of that dividend is held back by the company and paid to the US government. It's called withholding tax. And that is something which happens to even foreigners investing in India. Part of the or even NRIs, they invest in Indian stock and a certain part, I think about 10% or 20% is held back. So that is something which you have to bear with. You will invest, your money will be held back, and then you will get a credit at the time of your taxes. So you have to worry about that. But what happens if your one is faced with a fraudulent thing in the US with a broker? I don't think we have an easy answer to this. Now there is a third vehicle which is coming into being. Bombay Stock Exchange and National Stock Exchange are also facilitating Indian investors to invest abroad. So in that sense, this is better regulated. At least they have greater visibility. They are regulated entities in India, and they are expected to be building a robust, relatively safer mechanism for Indian investors. So BSE and NSE will enable opening of an account. Their procedures are different. NSE is permitting you unsponsored depository receipt for about 200 companies in the US. Bombay Stock Exchange is actually acting as a broker for Indian investors to invest abroad in many geographies. And these things are yet to be operationalized, and they are also facilitating a relatively more efficient conversion mechanism, converting your rupee into dollar for investing in these stocks. So, and they are still in the very formative days. There are very few investors who are getting started with this. So these are the possible vehicles. It will be possible for investors to invest abroad. There are nuances of this. Understand this well. One could be safer, one could be little less safer, but you will have to deal with these things yourself. What happens in mutual fund is pretty straightforward. You put your money, you get instant diversification, and when you want your money back, you take it back. Capital gains tax treatment is like that of a debt fund, which is hold it for 3 years, and whatever be the gain, it will be indexed and you will be liable for 20% capital gains tax post indexation. Investment of less than 3 years, it will be added to your income. All the gains will be taxable at your marginal rate. So mutual fund is good, mutual fund is safe, simple. The very reason why you invest in a mutual fund is the reason why you should invest abroad. Diversification, that is the ultimate de-risking mechanism, that is the ultimate risk management available to an individual investor. So you should invest. What percentage depends on how you want to approach it. The investment options are quite compelling. They are of a unique kind. So one should have it. Which vehicle you choose? Right now we are constrained. Mutual funds look to be the most efficient one. Next best, which is still open, is ETF. And if these two windows are not open, the rules for individual investors there who can invest abroad is $250,000, $2.5 lakh, which is about 1.9 crore. So it is quite a meaningful amount which every individual can invest in a financial year. So, but then after that you will have to worry about the vehicle that you choose. Ensure that they are safe entities to deal with, and make sure that you are able to build a well-diversified, high-performance portfolio for yourselves.
For a documented reading on the nuanced details of how to invest abroad and the different vehicles, the plus and minus of all this, grab your copy of the next issue of Mutual Fund Insight. Well, with that, it's a wrap. Keep watching this space for more information, and if you like the show, do subscribe to our YouTube channel. Keep watching. Take care. Bye for now.